Picture this. You've packed up your office, thrown your alarm clock in the trash, and are ready to ride off into the retirement sunset. Only problem, that sunset might come with a side of ramen noodles for dinner every night for the next 30 years. Hey there, future retirees. Welcome back to the channel where we tackle all things money, retirement, and the occasional awkward financial truth. Today we're talking about one of the biggest mistakes DIY planners make, retiring too early without adequate savings. Yep, we're diving into what happens when you let your dreams outrun your dollars. Spoiler alert, it's not pretty. So stick around as we uncover how to avoid this misstep and make sure your golden years don't turn into tinfoil years. And before we get started, hit that like button, subscribe, and share this video with your favorite early retirement dreamer, because they might need this wake-up call more than they know. Let's be honest, retiring early is the dream, right? No meetings, no Monday blues, just pina coladas and Netflix marathons. But here's the catch. The longer your retirement, the more money you'll need. If you retire at 55 instead of 65, that's 10 extra years of expenses, and you're shaving off 10 years of savings and compounding interest. Basically, retiring early is like signing up for a marathon and dumping half your water bottle before mile 1. Not the best strategy. So let's break down why this dream could turn into a nightmare if you're not careful. Okay, here's the math. Let's say you need $50,000 a year in retirement and you plan to live to 90. Retiring at 65, you're looking at 25 years of expenses, or about $1.25 million, assuming no inflation. But retire at 55? Now you're looking at 35 years of expenses. That's $1.75 million minimum. And that's before factoring in inflation, healthcare, and surprise expenses like your grandkids asking for college help. And don't even get me started on Social Security. If you start claiming it at 62, you're looking at a reduced benefit forever. It's like getting a permanent discount on your paycheck, but in reverse. Not cool. So, how do you know if you're pulling the retirement trigger too soon? Here are some red flags. Your savings fall short of the 4% rule. If your savings can't support withdrawing 4% a year, you're in trouble. You have no healthcare plan. Medicare doesn't kick in until 65. Retiring early means covering those costs out of pocket. And trust me, it's not cheap. You're banking on unrealistic investment returns, thinking your portfolio will average 10% returns forever. That's optimism, not reality. You have outstanding debt, credit card balances, car loans, or even a mortgage. Those monthly payments will eat into your nest egg faster than you can say early bird special. You're relying on inheritance or a windfall. Hope is not a retirement plan. Unless that windfall is already in your bank account, it's not part of your strategy. Retiring early isn't just about having enough money to cover your expenses. It's about the costs you don't see coming. Healthcare costs. Retire at 55 and you're on your own for a full decade of premiums, deductibles, and co-pays. Inflation. A gallon of milk won't cost $4 forever. Over 30+ years, inflation can seriously erode your purchasing power. Longevity risk. What happens if you live to 95 or even 100? Outliving your money is the ultimate retirement nightmare. Market volatility. Retiring during a downturn can permanently damage your portfolio if you're withdrawing money while your investments are losing value. Here's how to check if you're actually ready to retire early. Calculate your FIRE number. This is your target savings amount based on annual expenses multiplied by 25. Plan for healthcare. Research health insurance options like COBRA, ACA plans, or an HSA. Stress test your portfolio. Run scenarios for market downturns, inflation, and unexpected costs. Have multiple income streams. Social Security, pensions, dividends, or rental income can provide a safety net. Work with a pro. A financial planner can help you avoid costly mistakes and make sure your plan is realistic. If retiring early isn't in the cards, don't worry. You can still enjoy a version of the dream. Semi-retirement. Cut back to part-time work. You'll reduce withdrawals and keep your savings growing. Side hustles. Turn a hobby into income. Who says retirement can't include a little Etsy shop or freelance gig? Delayed retirement credits. Waiting until 70 to claim Social Security increases your benefits by 8% a year after full retirement age. That's a guaranteed return you don't want to miss. Alright folks, let's wrap this up. Retiring early is a dream worth chasing, but only if you're financially ready. Otherwise, you're trading a short-term win for long-term stress. So here's your homework. Run the numbers. Do you have enough saved to cover 30+ years of expenses? Plan for the hidden costs, especially healthcare and inflation. Build a realistic retirement plan, and don't be afraid to get professional advice. And most importantly, share this video with someone who's dreaming of early retirement, but might need a reality check. Better to plan now than regret later, right? Thanks for watching. Don't forget to like, subscribe, and hit that notification bell so you never miss out on tips to secure your financial future. See you next time.